Scott Miner joins us now. He's Global Chief Investment Officer at Guggenheim Partners. Scott, great to have you with us. Wow, we've got a lot to discuss. What do you make of what we've seen in the last, particularly the last week or so?
Well, Julia, I got to tell you that everything that's going on here, I think, is a symptom of aggressive monetary policy globally and against the backdrop of more stimulus. So, you know, when you start to see these kind of, and I refer to them as crazy moves in stocks and other speculative assets, it's starting to tell you that you know, it's getting late in the party. And so now in the old days, the policy of the Federal Reserve was to take the punch bowl away just as the party's getting interesting. At this point, you know, they're basically spiking the punch bowl. And, you know, we're just, you know, I think we're in a speculative bubble that could go on for quite a while.
I was told last week that bubbles are a boomer mentality, Scott. That frightens me.
Well, it's, you know, certainly I can't argue with that. I think, you know, one of the things about bubbles is that they often go on longer than people expect, and they often go to extremes much higher than people would expect.
Yeah, and if people don't expect the bubbles to pop, they keep buying. Is it the role, and to your point about the fact that you would normally, in normal times, and this clearly isn't, and actually we haven't been in normal times for what, more than a decade, central bankers would take that punch bowl away, or at least they'd try and reduce the amount of liquid or liquidity in there, but we're not seeing that. Do you think there's a role for regulators in what we're seeing, whether it's making sure that margin requirements are there, whether they have cooling off periods in individual stock names that get lofty? We've also got the angle here of the social media driven frenzy in certain names too. I do think there's a lot perhaps to investigate, even if they take no action ultimately.
Well, I think there is a lot to be looked into here, Julia. I mean, first off, to just go back to margin requirements, at least in our country, in the United States, that's the business of the central bank, of the Federal Reserve. The Federal Reserve hasn't changed margin requirements in over 20 years. They seem hesitant to want to do it because I think they're afraid they'll get blamed for something, like, you know, somehow hurting the small guy.
You mean exactly what's happened here?
Exactly, right. And when you look at, you know, what's going on right now with a lot of these bubbles or stocks or squeezes or shorts, however you want to talk about it, you find that there's a lack of sophistication by the players. And there's two things that are disturbing. If we take the GameStop episode, professional investors who are shorting a stock that has, you know, where the short is 130% of its total float is just sounds kind of stupid to me. Nevertheless, you know, when you turn it around and you get these retail investors in who have very little experience and they can squeeze the short, of course they can make a lot of money. But now they translate that into, well, let's go after silver. Well, silver's a different beast. I mean, the market cap of silver is huge compared to what the market cap of GameStop was prior to, you know, taking on the shorts.
Yeah, and I mentioned that at the top of my show. This is an entirely different beast. The fundamentals, the size of this market, when you're looking at shorts or longs globally, you have to look at the picture and not just in one location as well here, Scott. Where do you see it ending?
Well, you know, the old, yeah, well, will end eventually. The old line is, you know, this will end in tears. Eventually, a lot of the people who have participated in the GameStop rally are going to discover that they can't get out of their positions and that the market just gaps lower on them. And they're going to lose a lot of money. Of course, that will be another event that leads to regulators wanting to take a hard look at what's gone on here. But, you know, as I mentioned earlier, Julia, I still think we're fairly early in this game. And, you know, this liquidity bubble certainly could go on well until the end of the first quarter and perhaps, you know, maybe even into next year.
Where does that leave Bitcoin? Scott, and do you see this as part of the same thing? Because the speculative frenzy, as you called it right at the beginning of this interview, sort of began with the dramatic rally that we saw in Bitcoin, and it sort of moved on to other assets and individual stock names, as we've mentioned. Is Bitcoin part of this, and what are your views on that at this moment?
Well, it's very interesting, Julia, because we've been looking at Bitcoin for, almost 10 years. And the size of the market just wasn't big enough to justify institutional money. As the total market cap of Bitcoin got bigger, around 10,000, it started to look very interesting. My view is, we did a lot of fundamental research, and if you consider the supply of Bitcoin relative, let's say, to the supply of gold in the world, and what the total value of gold is, if Bitcoin were to go to those kinds of numbers, you'd be talking about $400,000 to $600,000 per Bitcoin. Now, that I'm not saying we'll ultimately get there, but that's an indication of what might be a measure of fair value. That gives you a lot of room to run. But then when you consider that within a course of a month, we went from 20,000 to 40,000 on Bitcoin, that smacks of short-term speculation. And so I agree with you. The speculation sort of got started there. Now the air's coming out of that speculative run, and so the money is migrating into other places. And as I indicated recently, I don't really see the institutional support today, which is just coming online from the likes of people like BlackRock and Guggenheim and other large institutional investors, being big enough to support the valuation at its current levels. So, Bitcoin has had a lot of times where it's had setbacks of 50% from its highs. I wouldn't be surprised to see that happen again. But I do want to say one thing. Your comment about Elon Musk before we got started, Elon has definitely proven himself to be a visionary. And I think that cryptocurrency has come into the realm of respectability and will continue to become more and more important in the global economy.
I just wonder whether the perceived interference in what we've seen for things like GameStop, perhaps the lack of success in moving a market like silver, pushes that money and that interest back into something where there's less interference in something like Bitcoin, or at least the perception of it.
Well, it's interesting. There's a lot of potential targets out there for speculative activity. Among those, of course, people have been talking about SPACs, special purpose acquisition companies. There's been a huge surge in the amount of SPAC issuance. So, this money will find another home, and they will find another speculative asset to push up. And it's going to be something that's got to be thinly traded. It can't be something like gold or silver where you have large amounts of it and it's traded every day.